Have you ever wondered why some traders survive for years while others blow their accounts in a month? Welcome back to the channel. Today we're breaking down one of the most important topics in trading, risk management. The real strategy traders use to protect their money and survive in the long run. You can have the best technical skills, the best indicators, or the best strategy, but if your risk management is weak, one bad trade can wipe everything out. So in this video, I'll show you the simple steps that real traders follow every single day. First, traders decide how much of their account they're willing to risk per trade. Professionals usually risk 1% or less of their capital. That means if your account is $1,000, the maximum you should lose on a single trade is $10. This small number is what keeps traders in the game. Without it, people get overconfident, take oversized trades, and blow their accounts. Next, traders always use a stop loss. A stop loss is not about fear, it's about discipline. It tells the system to close the trade automatically if the market goes against you. This prevents emotional decisions and keeps losses controlled. Many beginners skip stop losses thinking they will watch the chart, but that never works in the long run. Then comes position sizing, deciding how big your trade should be. Position size depends on your stop loss, distance, and risk per trade. For example, if you risk $10 per trade and your stop loss is 20 pips away, your position size must be small enough that a 20 pip loss equals $10. This is how traders stay consistent no matter the market. Another key rule is avoiding overtrading. Professionals don't take trades just to be active. They wait for high probability setups and skip everything else. Trading less often actually protects your money and increases long-term profitability. Traders also diversify their trades. This means they don't put all their risk on the same currency pair, stock, or market condition. If everything moves in the same direction, one big event could cause multiple losses. Smart traders spread risk so that no single trade can ruin their day. Finally, the most underrated part of risk management is knowing when to stop trading. Professionals set a daily loss limit, often 2% to 3% of their account. If they hit that limit, they walk away for the day. This prevents emotional trading, revenge trades, frustration, and large losing streaks. In short, risk management is not complicated. It's about protecting your capital so you can stay in the market long enough to grow. Risk small, use stop losses, calculate position sizes, avoid overtrading, diversify, and know when to stop. Follow these simple rules, and you'll trade like the people who survive, not the ones who disappear. And here's something most traders never talk about: the mindset behind risk management. Real traders treat trading like a business, not a gamble. They understand that consistency beats excitement, patience beats impulse, and discipline beats luck every single time. They journal their trades, review mistakes, track winning patterns, and remove emotions from decision-making. They know that protecting the downside is the only way to access long-term upside. And if you want to go even deeper, look at how professionals constantly track their risk-to-reward ratio, adjust lot sizes according to volatility, and follow a written trading plan instead of relying on emotion. These habits separate successful traders from inconsistent ones.